Hey guys, it's me again, Noah from the Stock Market Nerds, and I'm the value investor. In the last video I talked about the power of stories in valuation and why they have such an enormous impact on your valuation. In this video I'm gonna show you the first step in making a story about a company. Every company lives through a specific life cycle with maximum 6 and minimum 1 stage. In which stage of the life cycle the company is has an enormous impact on the future growth of the company and therefore on your story and valuation. Because it's a big difference if you value a high growth company or if you value a low growth company. If you want to do valuations, you have to learn which stages of the life cycle there are, how you can recognize them, and how you can interpret them. Startup. That's the first stage of the life cycle of every company. In this stage, you have an idea for a business that fits an unmet need in the market. In German, we call an unmet need in the market a Marktlücke. For instance, most companies in Shark Tank are startups. They are normally growing enormously fast but are almost never listed on a stock exchange, and so they are not really important for us as stock market investors. Then there are young growth companies. In this stage, the idea for a business gets converted into a real business and into potential for revenues and earnings. Snapchat, for instance, was a young growth company a few years ago where they built up their social network and their user base, and therefore they built up potential revenues, which they now more and more convert into real revenues. So they are now actually in the high growth stage. In this stage, you convert the potential for earnings and revenues into real earnings and revenues. Also in this stage, companies are normally growing very fast. And they are often money losing because they have to invest a lot of what they earn back into the business. Then there's the major growth stage, in which companies are still growing very fast, but they are already making profits and are not growing as fast as a high growth company. And then there's the major stable stage, in which companies are growing pretty much at the rate of the economy. So they are making large profits and normally paying out large dividends and doing stock buybacks. The last stage is the decline stage, in which the company's earnings and revenues shrinks and it gets eventually acquired or it goes bankrupt. As I said, neither young growth companies nor startup companies are normally listed on a stock exchange, and so they are not really important for us as stock market investors. Therefore, we will focus today on high growth companies, stable growth companies, major stable companies, and declining companies. I think the best way to explain each of these stages is by showing an example of a company in every stage. So let's get started. An example for a high growth company would be Tesla. They are just focusing on expanding their business and investing as if there would be no tomorrow. They don't care about losses. Also, Amazon was such a company for a long time. Amazon is now in the intermediate stage because they already make profits but are growing very, very fast. So they are in the stage between the high growth stage and the major growth stage. An example for a company in the major growth stage would be Google, Microsoft or Facebook. These companies are, as I say, still growing very fast, but not as fast as high growth companies. And they're already making large profits. Then there are the major stable companies. These are companies like Coca-Cola, Pepsi, Philip Morris, Ford, and so on and so forth. They are not growing very fast, but they have a solid profit and they normally pay out large dividends and buy back shares. Then there's the decline stage. A perfect example for this is Yahoo in the last few years. Their revenues declined every year and now they eventually got acquired by another company for a very low price. If you're doing valuations and making stories about companies, you have to include in it in which life cycle or in which stage of the life cycle the company is. When we do real valuations, you will see why that's so crucial and important. But how can you recognize it? How can you recognize in which stage of the life cycle the company is? Well, there are a few factors. Recognizing the life stages of a company is first of all also an intuitive thing. So it's pretty intuitive that Tesla, for example, is a high growth company. But there are a few other factors. One factor is, as I said, a very high reinvestment rate, with which you can recognize high growth companies. So if the reinvestment rate is higher than 100% and the company is still making losses, then it's very probable that this company is a high growth company. But not always, because Amazon, for example, does already make profits but is still a very high growth company. Here you can also use the stock market as an indicator. For example, Amazon is trading at a PE ratio that's just the price divided by the earnings of the company, but we'll cover ratios in a later video, of 195. That's pretty high, and so also if the market is not always right, if a company is trading at a PE of nearly 200, it's very probable that this is a high growth company. As a rule of thumb, you can use that a company with a PE that is higher than 80 is most of the time a high growth company. You can of course also use historical data. If a company, for example, grew 100% or more in the last 5 years, then it's very probable that it's a high growth company. Stable growth companies are companies that are still growing very fast, but not as fast as high growth companies. As I said, examples for stable growth companies are Facebook, Microsoft or Google. Again, as a rule of thumb, you can use a PE ratio which is higher than 30 indicates a stable growth company. These rule of thumbs are just rule of thumbs and not universal, applicable or right. For example, in a stock market crash, PE ratios will tell you nearly nothing about in which stage of the life cycle the company is. But you can use PE ratios as one indicator, and in healthy times in the economy and the stock market like now, they can be very helpful in finding out the stage in the life cycle of a company. Major stable companies like Coca-Cola, Philip Morris or Ford are pretty good recognizable by historical data. So if the revenues and earnings were flat in the last few years or they just grow by a few percent, then it's probable that it's a stable major company. You can also use the stock market again and use as a rule of thumb again a PE ratio of 20 or lower, which indicates a stable major company. And the last stage of the life cycle are declining companies. Like, as I said, Yahoo. You can recognize them, one, with historical data, and when the revenues, for example, declined the last few years and the earnings declined, then it's probable that's a declining company. You can again also use the stock market, and there's a ratio that's called price to book ratio. I'll cover that in a later video. But anyway, if the price to book ratio of a company is lower than 1, it's often, not always but often, the case that the market prices in a declining company. Also, a PE ratio that is lower than 10 or for example also lower than 5 indicates a declining company sometimes. As I said, these are all just rule of thumbs, but you can use them and they can be a helpful tool besides intuition and other factors like historical data, reinvestment rate and so on. So again, if you're making stories for valuations, it's very important to include in it in which stage of the life cycle the company is. You'll see why that's so crucial and important when we do real valuations. And if you learn it now, it will be enormously helpful to make great valuations, invest successfully and earn a lot of money. And that's our ultimate goal in investing. So I hope you were able to learn a lot in this video. And I'm looking forward to speaking to you again. If you liked the video, please leave a comment, leave a like and subscribe to our YouTube channel. So see you next time and always remember, Umsatz kommt von Umsetzung.